headwinds from global forces, namely protracted geopolitical tensions, rising global financial market volatility, tightening of global financial conditions, and global recession risks. Taking all these factors into consideration, the real GDP growth projection for 2022-23 is retained at 7.2%, with Q1 at 16.2%, Q2 at 6.2%, Q3 at 4.1%, and Q4 at 4%, with risks broadly balanced. Real GDP growth for Q1 23-24 is projected at 6.7%. Now there may be a question which of course will come in the subsequent press conference, but I think to remove any ambiguity even at this point of time, let me say that somebody might as well ask that in the Q3 and Q4 of the current year the growth goes down to 4.1% and 4% in Q4, then suddenly it goes up to 6.7% next year. What is happening is that the base effect is at play, and the 4.1% and the 4% in Q3 and Q4 of this year are primarily due to base effects. We can explain in more detail during the press conference which will come up at 12 p.m. Inflation. Now let me focus on inflation. June 2022 was the 6th consecutive month when headline CPI inflation remained at or above the upper tolerance level of 6%. Looking ahead, the inflation trajectory continues to be heavily contingent upon the evolving geopolitical developments, international commodity market dynamics, global financial market developments, and the spatial and temporal distribution of the southwest monsoon. Since the last MPC meeting, however, there has been some let-up in global commodity prices, particularly in the prices of industrial metals, and also some softening in global food prices. Domestic edible oil prices are expected to soften further on the back of improving supplies from key producing countries and government's supply side measures. The resumption of wheat supply from the Black Sea region, which happened a couple of days ago, if it sustains, could help to temper international prices of wheat. Supply chain pressures, though elevated, are on an easing trajectory. Further, the advance of the southwest monsoon is by and large on track, and Kharif sowing has picked up in recent weeks. The shortfall in Kharif sowing of paddy, however, needs to be watched closely. Although the huge buffer stocks that are available are, will provide some kind of moderating impact on possible inflation. Household inflation expectations have eased, but they still remain elevated. Incidents of unseasonal and excessive rainfall, if any, can impact food prices, especially the prices of vegetables. Greater transmission of input cost pressures to selling prices across manufacturing and services sectors may also create fresh price pressures. Moreover, persistently elevated cost of living conditions could translate to higher wages and further price increases, especially if pricing power of firms strengthen. Taking into account these factors and on the assumption of a normal monsoon in 2022 and average crude oil price, that is Indian basket, of $105 per barrel, inflation is projected at 6.7% in 2022-23, that is the current year, with Q2 at 7.1%, Q3 at 6.4%, and Q4 at 5.8%, with risks evenly balanced. CPI inflation for the first quarter of next financial year 2023-24 is projected at 5%. The inflation trajectory is now poised at a decisive point. While there are incipient signs of a confluence of factors that could lead to further softening of domestic inflationary pressures, there remain significant uncertainties. In such a milieu, with growth momentum expected to be resilient despite headwinds from the external sector, monetary policy should persevere further in its stance of withdrawal of accommodation to ensure that inflation moves close to the target of 4% over the medium term, while of course supporting growth. A calibrated approach would provide sufficient flexibility to monetary policy in the current uncertain environment. Now like to turn to liquidity and financial market conditions. The introduction of the standing deposit facility, that is SDF, in April this year, which raised the floor of the liquidity adjustment facility corridor, that is the LAF corridor, by 40 basis points, along with policy repo rate hikes of May and June, have effectively resulted in withdrawal of accommodation by 130 basis points. Consequently, the weighted average call rate, that is the WACR, which is the operating target of monetary policy, has commensurately firmed up. At the longer end of the money market, interest rates on 91-day treasury bills, commercial papers and certificates of deposit have also moved higher since April. The rate hikes also triggered an upward adjustment in the benchmark lending rates by the banks. Term deposit rates are also increasing, which should bode well for availability of funds with the banks in the context of sustained buoyancy in credit demand. Surplus liquidity in the banking system, as reflected in average daily absorptions under the LAF, both SDF and variable rate reverse repo auctions put together, moderated to 3.8 lakh crore rupees during June-July this year against 6.7 lakh crore rupees during April and May. In other words, what I am saying is that thanks to the efforts taken by the RBI to undertake the SDF measure, the VRRR measures, which you are familiar with, the surplus liquidity in the banking system has come down from rupees 6.7 lakh crore in April-May to 3.8 lakh crore rupees during June-July this year. The sharp moderation in surplus liquidity from July 20th of this year, mainly on account of tax and capital outflows, resulted in money market rates firming up above the repo rate. Alleviate the liquidity stress, the RBI conducted a variable rate repo auction of rupees 50,000 crore of 3 days maturity on July 26th. Going forward, and as indicated in my statement of February 2022, the RBI will remain vigilant on the liquidity front and conduct two-way fine-tuning operations as and when warranted. And the two-way fine-tuning operations will mainly be variable rate repo operation, that is VRRR operations, and variable rate reverse repo operations, that is VRRR operations. In other words, we will do fine-tuning operations in both directions depending on the evolving and the prevailing liquidity situation. And these will be of different tenors depending on the evolving liquidity and the financial conditions. During the current financial year, that is till yesterday, August 4th, the US dollar, that is the index, that is the DXY, has appreciated 8% against a basket of major currencies. And I am now talking about our financial year, that is from 1st April this year. So DXY has appreciated by 8% against a basket of major currencies. In this milieu, the Indian rupee has moved in a relatively orderly fashion, depreciating 4.7% against the US dollar during the same period, that is till yesterday. So the rupee depreciation has happened in an orderly fashion thanks to the stated policy of RBI and thanks to our steady improvement in the market to prevent volatility. So rupee depreciation has happened in an orderly fashion, and rupee has depreciated by 4.7% against US dollar till yesterday, and it has fared much better than several reserve currencies as well as many emerging market currencies as well as many of our Asian peers. And as I started reading this statement, the rupee since this morning has appreciated, and I think the depreciation instead of being 4.7% would be a little lower, but we have to of course wait till the end of the day, and it is a continuing process that goes on. The depreciation of the Indian rupee is more on account of the appreciation of the US dollar than weaknesses in macroeconomic fundamentals of the Indian economy. Market interventions by the RBI have helped in containing volatility and ensuring orderly movement of the rupee. We remain watchful and focused on maintaining stability of the Indian rupee. The Indian financial system, as I mentioned earlier, remains resilient. This will help the economy in emerging out of the shadows of the pandemic and the impact of the war in Europe. While the banking system remains well capitalized and profitable, a deleveraged corporate sector augurs well for sustaining the economic recovery. I would now like to talk a little bit about the external sector. The external sector has weathered the storm while navigating through the recent global spillovers. Merchandise exports grew in April to July, while merchandise imports surged to record high on the back of elevated global commodity prices. Consequently, the merchandise trade deficit expanded to US $100 billion in April to July this year. Provisional data, however, indicate that demand for service exports, that is services exports especially in IT services, remained buoyant in the first quarter despite global uncertainty. Exports of travel and transport services also improved in the first quarter of this year on a year-on-year basis. From the external financing perspective, net foreign direct investments, that is FDI, at 13.6 billion US dollars in first quarter of the current financial year was robust as compared to 11.6 billion in first quarter of last year. So FDI inflows have improved from 11.6 billion US dollars in the first quarter of last year to 13.6 billion US dollars in the first quarter of the current financial year. Foreign portfolio investment, after remaining in exit mode during the first quarter, that is Q1 22-23, turned positive in July this year, that is July 2022. Along with several other measures undertaken in July, the Reserve Bank has also used its foreign exchange reserves accumulated over the years to curb volatility in the exchange rate. Despite the resultant drawdown from our reserves, India's foreign exchange reserves remain the fourth largest globally. I shall now announce certain additional measures, the details of which are set out in the statement on development and regulatory policies, which form the part B of the MPC statement, which will be uploaded in the website immediately after my statement is over. The additional measures are as follows. The first set of measures relate to regulatory measures, and that relates to standalone primary dealers or SPDs. Standalone primary dealers, that is SPDs, have played an important role in the development of financial markets in India. Considering their potential in further facilitating financial market development, the following two measures are being announced for the standalone primary dealers. It is proposed to enable the standalone primary dealers to offer all foreign exchange market making facilities as currently permitted to Category 1 authorized dealers subject to prudential guidelines. This measure will provide customers with a wide set of market makers to manage their foreign currency risk. This will also increase the breadth of the forex market in India. The second measure in respect of the standalone primary dealers is that we have decided to permit standalone primary dealers to undertake transactions in offshore rupee overnight indexed swap market, that is rupee OIS market, with non-residents and other market makers. This measure will supplement a similar measure announced in February this year for the banks. These measures, that is the measure being announced today and what we have already announced for the banks, are expected to remove the segmentation between onshore and offshore markets. That is, I am referring to the OIS markets, and it will definitely, we do expect that it will improve